Hey everyone, and welcome back to the Your Money Your Life podcast. We're on episode 315 of the pod. So make sure wherever you listen, you like, subscribe, 5-star rate, and review this podcast. We try to do this every week. There's not crazy amount of stuff to go through this week. We'll get through it. There's a little bit of news. Not a crazy amount of news, but let's dive into a little bit of what's going on actually in the markets in every different area and scenario. Um, let's dive into it. So, first and foremost, we have interesting trading week. So, the market's been kind of ping ponging a little bit. There's been a little bit more volatility than normal. As you see year to date, this whole year, which has been a month and a half, we've had a little bit more volatility than we've had. But we're still up a bit above 1% on the S&P 500, around close to 1%, I should say, a little bit below 1%. And the main themes that are driving this is one, the interest rates, what's going to happen with interest rates. Two, earnings. Tech earnings is are things overwrought, overvalued when it comes to the AI hype, all these different things. In the short term, I should say. In the long term, they're incredibly undervalued. That's why you should be buying solid things that you believe in that are going to be used more in the future, right? So that's the big thing. On a 6 month basis, we're still up heavily. On a year basis, hovering a little bit below 15% increase. So again, the market has done really well if you look at it over the past several years. Despite any pullbacks and corrections, they've all recovered, and they will continue to do so when there's pullback and corrections. Really, what's happening is the current administration, what's going on is they're gonna they don't care about inflation as much. They care about increasing assets. They care about the stock market. They care about business economy flowing. And so that's going to continue to happen more than likely than not. Even if there's any corrections in the short term, they're going to bounce that and kind of have a floor based on the ability to manipulate's the wrong word, the ability to pull strings to make assets go higher, put money into the economy, lower interest rates. Those are going to cause assets to more than likely increase, which will also cause inflation to increase as well. But you can see it's the people that hold assets that win in this scenario. If you're holding a chunk of money in stock market, in real estate assets, you're going to have an evaluation increase of your assets over this period of time where you see that. And so what's going on in the stock market? It's mixed trading emotions in the futures right now. There is the labor market. We talked a little bit about that, but the labor market is another big thing. The labor market is showing strong payroll numbers that are pretty shocking. There was a sharp jobs growth for January non-farm payrolls report that was 130,000 increase in strong jobs last month, increase in payrolls, far above what economists were expecting. Economists were expecting about 45 to 50,000, if I'm not mistaken, and we had 130,000. That's strong. And then the unemployment rate went down to 4.3% from 4.4%. So we lowered unemployment. We had a strong January jobs report. And the market took that as a mixed result at first when this news broke. I think it came out at 8. The data came out at 8 or 8:30 Wednesday morning. The futures jumped, but then during the trading day, we were about flat to a little bit lower at the end of the close of the day. But again, that's just another thing that the investors have to digest. So the Federal Reserve interest rate outlook is another thing. It could mean fewer rate cuts than traders are hoping if a higher inflation also remains an issue. So this underscores the importance of Friday's CPI index, the consumer price index, which could show the central bank just what it needs for a dual mandate to come to a better balance. So that Friday's CPI report is going to be really crucial because they're going to be able to see what's going on with inflation or what's going on with inflation in the data, and if further rate cuts are needed now, or if not, if we're still having heavily increasing basket of goods and services month over month, year over year, an increase that's hotter than expected, then they're going to have to temper that and weigh that in. Initial jobless claims move lower also after a temporary weather induced bump, the Labor Department reported. So, again, this is just pretty much saying, hey, we have strong, the last month's data was saying we have a strong jobs market. We're going to get Friday's inflation report, and that's going to tell the market a lot on what's going on. So we'll have to keep our eyes on that. and it's going to be really, really crucial. More data. January's existing home sales reading is due out at 10 p.m. 10 a.m. Excuse me. So we'll get more and more and more data this week that's coming out. Let's look at current news and events. Meta got a $2 billion boost from Bill Ackman's Pershing Square. So Bill Ackman, for those who aren't familiar, he's a hedge fund owner and boss. Bill Ackman is doubling down on Meta despite bubbling investor concerns about the social giants growing AI costs. So one of the things about the earnings for tech this year was they're spending a lot more on AI than they had initially signaled, maybe even a quarter ago or a year ago. The increase in AI spend has bumped up many billions for all these companies. And so that's going to readjust the valuations for people that are doing discounted cash flow models or any of those things. That's going to adjust the valuations for folks because they have to bake in a lot more spend, which would presumably adjust profits to shareholders, which presumably will be adjust the valuation. So tech did see some of the tech companies did see a little bit of a pullback and correction because of that. But Bill Ackman says, "Hey, I'm purchasing a $2 billion stake in the company, or I have purchased." He said it's a sizable bet to the potential of Meta's artificial intelligence enhanced ads. So he's saying that AI is going to help them be more efficient, enhance their advertisements for people that are advertising on the platform. And he said it's going to affect content and wearables. Earlier this year, Meta said it anticipates AI-related expenditures to reach as high as 135 billion, and shares have fallen 13% since August. So again, he has high conviction that is Bill Ackman. So he has approximately a 10% of his firm's capital in Meta. That's a pretty and sizable position. He's betting on Meta. He probably won't see more. Most hedge funds have more than, unless they're really high conviction, more than 10% stake. That's a pretty high conviction of his capital that he's betting on Meta. And again, we like Meta, so I think as a long term holder, he's going to be fine. I think this is a fair trade. I don't know why. Is he just entering Meta? Was he not in Meta before? Is he just liking the discount or the correction and he's buying, doubling down and increasing his stake from before? Because again, I'm assuming he had stake in Meta already. But he believes that Meta is going to be a primary beneficiary of AI. I believe a lot of these companies will be Meta, Google, Amazon. They're going to be more efficient when the infrastructure is built out. They'll have less employee headcount. They'll be just working mainly with AI able to do a lot of things that an employee headcount had to do. Remember, if you think about the biggest expense for any company, it's the employee headcount. And they're betting on the ability to lower that through efficiencies in AI. And so that's interesting enough. Let's go to an older company, a stalwart company, McDonald's. Their US sales surge amid focus on affordability. So they're focused on affordability. McDonald's has reported a 6.8 increase in US sales during the fourth quarter, making it the fastest growing growth in over 2 years, driven by their value meals and promotions that they say resonates with cost conscious diners. It's a really stark difference from a year ago when they had an E. coli outbreak, depressed traffic. They're planning a new slate of beverage offerings for 2026. So McDonald's had a good earnings report. And again, that makes sense. If you're thinking about what we just talked about in the beginning of the podcast, inflation still having bearing effect. CPI numbers come out Friday. Now, if you're saying that McDonald's is focusing on cost conscious consumers, that's going to be helpful in a world where prices are crazy. If you can get a meal, they show like they will do like on social media all the time. They'll show like a comparison of McDonald's prices 20, 30 years ago versus now, and things have increased like 5, 10 fold, right? And so if you're doubling down on, hey, in this world with inflation out of crazy, we are still trying to provide value to our McDonald's eating customers, that may work. And it seems to be working. And heck, their food, Big Mac is good. If you're getting a Big Mac, fries, hey, I'm actually on a eat clean 2 month period, right? 2 or 3 month period. But of course we love that every once in a while, right? A cheat meal? No, you know. Let's go to social media. I actually thought this was interesting. It doesn't have much to do with finance, but there is an inquiry into social media and the effect on teens, the effect on people, addictiveness. And Adam Missouri, who's the Instagram CEO, he had to speak a little bit about that. But he's saying that social media is not clinically addictive. So he's saying it is not, NOT, not clinically addictive. And this is a landmark trial on tech and mental health. He did allow that the social media can have some negative impacts, but he did say that whether the Instagram always tests the safety of new features before they roll it out to kids and teens. And Meta and YouTube are currently facing a slew of lawsuits that claim social media can just be as addictive as cigarettes or gambling. So this is part of a Los Angeles Superior Court. It's part of a social media and safety trial involving Meta and YouTube. TikTok and Snap settled that are no longer part of this trial, despite being named as defendants in the lawsuit. It's one of several big social media trials this year that experts have likened to the big tobacco lawsuits from yesteryear. So they're interesting. This is a big deal. It's people coming. I don't know if it's class action or, but they're saying that social media is addictive and people need. I tend to agree with them. It's addictive because we allow it in the sense of like dopamine and you're bored and you're just going to scroll. But if you actually put your phone away, which I've started to practice every once in a while, just put your phone away and I don't miss it. Maybe I'm watching another screen, I'm watching something else, but it's just where's our eyeballs? Where's our attention? Where's our need for that quick fix dopamine of happiness? And TikTok and Instagram and all social media are part of that. But it's really just the human nature that we are in the weird world we live in currently, where there's just got to be looking at something, short form videos all over all the time. So, we can all practice putting stuff away for a little bit. That might be helpful. It will be helpful. That's a fact. Let's jump into the question of the day. There was a couple good ones that I wanted to go over. Two good questions of for this week. So, what is the deadline to file tax returns? That should be pretty easy for all of us, but it's actually interesting because it's usually April 15th. Um, I think this year I might even be April 16th, but I don't know if it's out files on the second Friday or something, or that might be what the actual denotation is. But let's find out. It says today, 2026, it is April 15th, 2026. Um, it's important to know the deadline. And I guess maybe it is always April 15th. I felt like one year was April 16th. Maybe I was getting my days mixed up, but yeah, it is April 15th. It always seems to be around April 15th. It is April 15th. Maybe it's a weekend this time. I'm actually curious. And it's a Wednesday, April 15th. And then you could, of course, extend. So some people like to extend the deadline, and that gives you to October 18th, if I'm not, or maybe October 15th, if I'm not mistaken. So those are the dates. Super simple one. Another question of the week. What is the cost of a 30-second Super Bowl ad? You've probably seen these numbers. They love to publish them every year, just showing the increase from year to year. And I think it was up to 8 million this year, if I'm not mistaken. And I am right. Answer's up to 8 million. Select spots, probably in the beginning of the game, cost as much as 10 million. Financial Times confirmed that broadcaster NBC Universal, owners of the NBC network, had sold Super Bowl advertising slots at an average rate of 8 million per 30 seconds. 8 million for 30 seconds. Think about that. 8 million for 30 seconds to get about over 100 million eyeballs on your product, on your service, on your ad. That's incredible to think about the cost of advertising, the cost of leaving an impression on viewers and potential customers. That's incredible. That is really, really outlandish. Well, folks, that's a Your Money Your Life podcast for this week. Make sure you like, subscribe, follow, comment on YouTube and all social medias. We'll talk to you every week like we do, and we'll see you next week.